Okay. So in the previous session, we were doing an exercise on the admission of a new partner in a partnership. So today we are going to finish off this exercise if possible. We ended at question 3, right? We ended at question 3, so yeah. We are going to finish off hopefully today, if it's not late. So question 3, we were asked to 7. Okay. Question 3, we were asked to calculate the amount of goodwill recognized when the new partner was admitted and prepare the journal entry for this effect. Okay. So calculating now. Calculating now the goodwill. We said this has to be or the formula of calculating now goodwill. This is the consideration amount minus the fair value of identifiable assets. So the first thing that we need to do, we need to calculate our consideration amount, and then we calculate our fair value of identifiable net assets, then we can get our goodwill. Okay. Let me just write down the formula quick before we move on with the table that we started. So goodwill equals to consideration, purchase consideration or consideration amount yeah, you can go use her phone. Purchase consideration minus the fair value of identifiable net assets then that's when you can get your goodwill. Okay. Let me just format this.
Sarah. Purchase consideration, is it the same as capital contribution by the partner for the total partnership?
It's the same as total partnership, total for the partnership, because that's the goodwill you'll have to use.
Okay.
Yeah. So purchase consideration is the same as total for partnership. Okay. So the first thing that we need to calculate here is our purchase consideration. Now, in this case, it's not really given. Now, and again, calculating purchase consideration, there is no format, or there's no fixed formula, if I can say, that we can use to calculate now the purchase consideration. It usually depends to the kind of question. It usually depends to what they say. However, I have a formula that I love using that might be of good help. So finding purchase consideration. We take our partner's contribution. Partner's contribution and then we divide it by, now in this case, we divide it by I'll say let's divide it by X because, okay, how will I explain this? Let me try to figure out the easiest way to explain this. Okay, so let me I'll say that, okay, the easiest way to explain now this purchase of consideration, you are given the profit sharing ratio of the new partner, right? And you are given the capital he contributed. So if we take the capital that he contributed, and then you divide it by the purchase consideration, so capital contributed by the new partner, you divide it by now the purchase consideration will give us his profit sharing ratio. There is the formula that I use to calculate now my purchase consideration. Now in this case, we are now trying to get, okay, we are given our capital contributed, we are given our profit sharing ratio, so we need to solve for X. We need to find our purchase consideration. That's what we are not given, and I mean that's what we are looking for. Ne? So capital contributed divided by purchase consideration equals to your profit sharing ratio for that partner. Now in this case, we are given profit sharing ratio, we are given capital contributed, we are now looking for our purchase consideration. Ne? So we solve for X. Now in this case, we have capital contribution by partner over X that we are looking for equals to 1/3. Like that. Sorry. So we are also given. Now the problem is I don't know how we're gonna do. Okay, I think let's do this. Can we quickly do this on a whiteboard? Because writing like this is a bit confusing. So I'll quickly just share a whiteboard, then we do the calculations on a whiteboard. Hello? Can you guys hear me?
Yes.
Okay. I'm quickly just looking for the whiteboard here.
Can't we just say the capital contributed by the new partner, which is 440,000, divided by his profit sharing ratio?
Yeah. Yeah, I think that's also another way that you can do. So if you take 44000 divided by 1/3, it will give you 132,000. And with the formula that I was doing, we'll still like get to that. Because if we solve for X, when we are going to solve for X, then we'll also end up getting the same answer. We'll also end up dividing 440,000 divided by 1/3, divided by his profit sharing ratio, then we get 440. But I think that is actually the way that I have been using. So maybe let's do it your way. I think it will also be easier for the other students.
Yes.
Yeah. Because mine is a bit long, then you guys can get confused or so. Okay. So purchase consideration equals to capital contributed by the partner then you divide it by his profit sharing ratio. So we know that in this case, our capital contributed by the partner was 440,000. And then we divide it by 1/3. Let's use brackets, 1/3. Is it 1/3? Yeah, 1/3.
Yes.
Also bracket. And then you get a purchase consideration of 1,320,000. And then now after you get your purchase consideration, you also need to find your fair value of identifiable net assets. Fair value meaning the new value of your assets that you have after your revaluation. So that is the amount that you use. So in this case, we have now calculating our fair value of identifiable assets. Fair value of identifiable assets will be in this case equal net assets as at. Now you use the net assets that you are given in your, sorry. So you have, now we are trying to find our fair value of identifiable assets. Therefore, now in this case, we take our information that you are given in the financial statement of December 2017. So in this case, we are told that now when it comes to the fair value of identifiable assets, we have to take our owner's equity per statement, per the financial statement that you are given, sorry, not net assets. So owner's equity as per financial position statement. As per financial position statement of, in this case is 31 December 2017. And then you add your revaluation surplus. Ne? Remember the revaluation that we made. Now we add either our revaluation, total revaluation surplus if we made a profit on all the revaluations, or our revaluation loss. loss on revaluation. But in this case, looking, so where do we get this information? So let me quickly just write the revaluation surplus. Revaluation surplus. So again, now we have to calculate our revaluation surplus. So if we go back to our journal entry, if we go back to our journal entries that we did, we can see land and building has appreciated with 130,000. Machinery also appreciated with 130,000. And then we made a loss on inventory and also a loss on accounts receivables. So what happens is that we now need to calculate whether our total revaluation surplus, if we made a surplus, or our loss on revaluation. So we take now 130,000 because there's a surplus, plus another surplus of 10,000. And then in that case, we get 140,000 as surplus. And then we subtract our losses that we have. So in this case, we have 140,000. So 140,000 minus 15,000, and then we get 125 as the revaluation surplus. Are we together? Do you guys understand?
Yes.
And the rest, do you guys understand? Martha, Naledi, Cynthia, Dilly?
Yeah. Yeah. Oh, I think I'm a bit lost.
Okay, where don't you understand? Maybe I can repeat.
No, I'm fine. The last part.
Okay, the last part of fair value of
Yes.
identifiable assets.
Yes.
Okay, I'll explain later. So we say that finding our fair value of identifiable assets, we have a formula that we use, which is owner's equity as per financial position statement, 31 December. This owner's equity, you go to the financial position statement that you are given, and then you take your owner's equity amount that is appearing there. And then you add your revaluation surplus. And if it was a loss, let me say it was now a loss on revaluation, deficit on revaluation, then obviously you have to subtract. But in this case, we made a profit on revaluation, so it will be revaluation surplus.
Oh.
Yes.
Okay.
Now we said that, now where do we get the revaluation surplus? We said that if we go back to our information, to our general journal that we did previously, we have our recordings of our revaluations. We said that land has increased in value, so it's kind of like a profit to us. It's a good thing to the business. So it increased in value with 130,000. Also, machinery increased in value with 10,000. So what is our total surplus? It's 140,000. And then we made a loss, or in other words, inventory. Inventory lost value of 5,000, and accounts receivables also lost value of 10,000. So these are losses. So what you have to do is we now have to find our net revaluation surplus, or net loss on revaluation. Okay, and then from there, now we have 130,000 plus 10,000, and then we minus these losses, 55,000 plus 10,000. So that will be 140,000 minus 15,000, and then we get 125,000 as our revaluation surplus. plus. Do we understand now? Do we all understand?
Yeah, it's now clear.
Okay, so let's go back to our information that was given. Oh, you're disturbing me. Okay. So we said a fair value now fair value equals to our owner's equity. So going back to our activity, let's look at our activity. What is our total owner's equity then? What is our total equity?
This one, okay, 1003.
So 1,003,000 net. Okay, and then we calculated, our revaluation surplus is how much?
125,000.
125,000. So our fair value will equal to how much? So what will be our fair value amount?
Okay.
So our fair value amount will be how much?
1,128,000.
878,000.
1,128,000. So that will be our fair value of identifiable asset.
Okay.
Identifiable assets. Okay. Now that we have our fair value of identifiable assets, and then we also have our purchase consideration, then we can easily calculate goodwill. You understand? So we can easily calculate goodwill as. Now we said that going back to our goodwill formula.
Wait.
Yes.
No, okay, I got it now.
Okay. Now going back to our goodwill formula, we said that goodwill equals to purchase consideration minus fair value of identifiable net assets. And that's what we were asked to look for. So in this case, it will be goodwill equals to our purchase consideration, which is 1,320,000. And then we subtract our fair value of identifiable net asset, where we got as. Yes, please go. As 1,128,000. So what will be our goodwill amount?
192,000.
So our goodwill will be 192,000. Is it clear?
Yes.
What does GW stand for?
Oh, sorry, goodwill.
Goodwill.
Yeah.
Oh, thank you.
Let me just write
So
it.
that's how we find. So that's how we find goodwill. Oh, my
Yes.
goodness. How many marks?
It can be 5.
Yeah.
Apparently, how many marks?
So it's very important. Like calculating goodwill is very important because there are follow-up questions as well that come that has to do with goodwill that you need goodwill in order to answer them.
Sure.
Yeah. So are there any questions before we move on? Why is my granny calling me now? Any
No.
questions? Okay. So after we calculate goodwill, we move on to the next. What is it? What is the question? Listen, calculate the amount of goodwill recognized when the new partner is admitted and prepare the journal entry to this effect. So we need to calculate. Oh, we have 10 minutes left. So we need to calculate now. In this case, we need to calculate. We calculated our goodwill amount. So we need to prepare journal entries of this effect. Okay? So let's calculate our journal entry. Let's quickly calculate our journal entry. Okay. So let's calculate goodwill. Now, what is it? Now in this case, you are not told or you are not given instruction of whether goodwill will appear in the new books of the partnership. Now you're only asked to calculate the amount of goodwill recognized. Now in this case, when the new partner was admitted and you prepare the journal entry to this effect. In other words, how is goodwill going to be distributed now among the partners? Okay. How are we going to distribute the goodwill among the partners? So in this case, usually in cases where you are not told to whether goodwill, there are two types of distributing goodwill. Okay? In cases where goodwill is not to appear in the new books of the partnership, you will have to calculate goodwill and share it among the old partners. Okay? And then cases where you were told that goodwill had to appear in the books of the old partnership, you have to distribute goodwill in 2 times. First, when it's appeared using the old ratio, and then secondly, you also have to use your new profit sharing ratio. Do you understand? In cases where you are told that goodwill is to appear in the books of in the new books of the partnership. Is it making sense?
Yes.
So if we want to discontinue the goodwill, we need to share it between our partners that we have. And then if we want to put it back in the books, we have to share it with the new ratio.
Yes, that's what I'm saying, with the new ratio. If you want it to appear in the books, in the new books of the partnership, you have to share it using the new partnership. Where now you have to include the new partner that you just admitted. However, if it's not to appear in the new books of the partnership, then you only have to share it among the old profit sharing ratio. In other words, among the old partners.
Okay.
Yeah. So let's recognize goodwill quickly. So in this case, that we said that goodwill is kind of like a benefit you get or an extra amount that you get for having a good reputation, for building a good brand name of your business. Meaning it's a gain to the partners. Therefore, it will have to be credited on their capital accounts. It will have to be credited on their capital accounts. So in this case, we'll have to debit goodwill. So our goodwill, we said it. When we calculated goodwill, how much did we get?
190.
192,000.
Okay. So we got 192,000. 192,000. Now we have to share it among the old partners. We have to share it among the old partners. So in this case, it will be 192. We have partner Mary. So we have to credit Mary's capital account. Capital Sarah and capital Mary. And also capital Mary. Okay. So what was their old profit sharing ratio?
3:2.
3:2.
Okay. So Mary, first 3:2. Yes. Okay.
Like Sarah got 3 and Mary got 2.
Oh yeah, the ratios. Okay. So in this case, we have 192,000. And what is Mary's? What is Sarah's profit? What is Sarah's profit sharing ratio?
It's 3/5.
3/5.
So we multiplied by 3/5. Ne? So how much will Sarah get? 115,200. Ne? And then we have capital Mary. 192,000. Multiplied by how much? What is Mary's capital sharing ratio?
2/5.
2/5. So how much will we credit Mary's account with?
76,800.
So we have 76,800. Is it 800?
Yes.
So we have
800.
76,800. So let me just show this. There is question 3. Now where do I read? Okay, somewhere here. Let me just. So question. Is it question
4?
No, this is the journal entry to account for goodwill. And then we are still to go now to question 4, which you have to show the journal entry to record the partner's contribution to equity of the partnership. Yeah. So question 3. And then we move on to question 4. Now, in this case, question 4. So for the narration, in case you're asked for the narration, this is just a journal entry to show the recognition of goodwill, how goodwill has been recognized. Of goodwill. Oh, question 4, you are asked to prepare the journal entry to record the new partner's contribution to the equity of the partnership. In other words, we have less than a minute. Okay. In other words, how much is the new partner contributing to the equity as capital? So we need to do a journal entry to show his contribution, or to journalize his capital that he contributed. So obviously, in this case, if the business is receiving, our bank has to increase, right? And then we credit his capital account. So we'll have bank